Chris, you've had a few moments to gather your thoughts on this one. What's your reaction to these record numbers out of Goldman Sachs?
Well, John, I think there's more to continue. I wouldn't be surprised if we have another really good quarter in Q3. And I think that, as the point was made in the release, the runway is still very good for additional earnings. And I think that applies to other banks besides Goldman.
How well priced do you think we are for that story, based on the reaction we've seen to the numbers so far this morning?
So I think the marketplace may temporarily sell the news, but I still think people will come back to these stocks. They're not expensive on 27 earnings, and I think the attitude towards 27 should be more bullish, and I think estimates can rise for next year. Plus, I think the second half of this year will still be quite good. So I think estimate increases are going to drag stocks higher.
At a certain point, though, Chris, do you think that expenses are going to sort of be the weight on these names? We see that as the excuse being used for the JP Morgan share decline so far this morning.
I think credit costs are a piece of the expense puzzle. So if you look at overhead, you're correct. But I also think if you think about credit costs, they actually beat on provision expense and charge-offs. And I think that credit theme being positive is a huge factor in favor of these companies.
If you think that there's more to come, and that certainly seems to be what David Solomon is indicating in his commentary in the letter ahead of earnings, what is the argument here for the economy slowing down and, frankly, for the Fed not to hike rates?
Well, I think the banks are taking share, number one. I also think the way the curve is acting favors the way banks are positioned. There still is a refinancing of loans for many mid-sized companies from 2022 and 21 that is going to benefit net interest income and margin the second half of the year. I still think overall volumes are going to be consistently good. And then you layer in the operating leverage in the space plus low credit costs. That continues to factor into very good earnings. And then let's not forget the capital build that is in the space. And ultimately, that's going to lead to more buybacks and I think greater investor confidence, which gets back to the PE expanding.
This is the kind of economic activity that these banks can leverage. This is the kind of capital markets activity that these banks love. And Chris, we've seen that through the pure plays, the likes of Morgan Stanley, the likes of Goldman Sachs. Those stocks have been absolutely flying. Chris, let's talk about is an area of this market that you know well. It's the regionals. The regionals are up by close to 18% so far year to date. That's outperformed many a big bank on Wall Street, with the exception of Morgan Stanley and Goldman Sachs. Chris, what's providing the regionals with this kind of tailwind right now? And away from capital markets and that business, is that set to continue?
I think it is because there's regulatory relief, John, and I think ultimately the way that the Fed and OCC has teed up the industry, there is a window for expansion in the space. I think you will see more M&A. I also think the companies themselves are getting this capital relief and I think a better regulatory attitude that ultimately leads to better earnings, a little bit less regulatory spend than what they were spending a few years ago, and ultimately it weaves back into higher confidence about the earnings.
So, Chris, when we see these consumer sentiment numbers and they are rock bottom, they are absolutely awful. And I understand why. I respect it. The accumulation of problems when it comes to prices and inflation. And we'll see CPI again in the next hour or so. Are you saying that you're seeing activity that corresponds with a pickup in loan demand across small and medium-sized businesses, consumer demand as well, that's going to provide gains for these guys?
Yes, and I think historically, if you go back to the 80s, John, when we had early 80s inflation, the banking system had more credit and expansion of credit was definitely a theme. You can go back to the old Berkshire Hathaway annual reports to confirm that. I do think you're going to see better credit demand. The Fed H8 data has been rising in recent weeks. So I think this quarter is a trigger point towards a higher second half on loans.
Chris, you keep saying that this is a good regulatory environment, a really good one. And I wonder, when you say gaining share, if the banking sector is winning back business from private asset management firms that had been eating their lunch.
Yes, I think that's true. And I think we see a little bit this quarter, and I think we'll see a lot more of it the next 3 to 4 quarters.
Which bank do you think is poised to benefit the most from that share consolidation?
Well, certainly the regional banks who have lost a little bit of business and have been trying to fight back. So that goes back to Fifth Third. It also goes back to PNC and Truist, those who are still reporting as the week goes on. But I think to some extent the national players at B of A and JPM should benefit, and Wells as well. So I don't think it's just related to the regionals. I think it is a large cap bank, systemic benefit.
Is the read here that ultimately the economy isn't just solid, but that it seems to be reaccelerating? And I say this based on the fact that loan loss provisions have come down, that there is the expectation for this to continue even in the face of inflation and rates that potentially are going to stay where they are or go higher?
I think that's true, and I think there's a lot of regular way activity that the banks see. So we've talked so much about AI in recent quarters that the non-AI spend is still there. It may not be as big, but it is still positive, and I think the banks are picking up more of that. I also think there's been less distractions this year because you haven't had any problems in the banking system to kind of distract investors. That's part of my thesis, that you could see earnings get better, demand better, and also multiples expand on the 27 estimates.